Okay, so I want to talk about how to put these transactions into the T account. Normally we'll journalize these because that's what our problems will ask us to do. But in order to understand those journals, it helps us to see what it would look like in T account form. So you can easily see that to increase assets, we increase them on the left with a debit. You can see that we increase liabilities on their right side, capital on their right side, fees earned on their right side, and expenses on their left side. So having this in front of us helps it to make more sense. And I've also made a list of what we're going to be using our accounts for. So when we go through this problem, we can double check that we're using the right account. January 1st, the dentist opens the dental practice by depositing $10,000 into a bank account in the business name. This is the dentist putting personal money into his business as an investment. So if you look at the word capital here, it is used when the owner invests personal money into the business. This dentist put in $10,000, so we increase capital on the right side. He put $10,000 into the business, so that means that cash increased, and it increases on the left side, which is a debit. So this first journal entry says debit cash, credit capital. January 2nd, the dental business borrows $100,000 from the bank. So whenever we borrow money, we're talking about a payable. Notes payable used when you buy something and promise to pay later or borrow money from a bank or a creditor. So we're going to increase our notes payable because now we owe the bank $100,000. And they gave us cash, the bank gave us cash, so cash goes up by $100,000. January the 3rd, the dentist pays for malpractice insurance for the month, $2,000. So an expense is used when you pay for something that will be used up or consumed within a month. And we paid for insurance that we're going to use within the month, so that would be insurance expense. And since it says we paid it, then cash is going to go down by $2,000. January the 4th, purchases for cash dental equipment including x-ray machine, chair, etc. for $60,000. When we talk about equipment, we're talking about this equipment account used when you purchase equipment. So equipment goes up because we got some equipment worth $60,000. And it says that we paid cash, so cash goes down by $60,000. January 20th, the dentist pays for a billboard to advertise his services for 1 month for $500. So we're talking about an expense because it's used when you pay for something that will be used up or consumed within a month, and this would be advertising expense. So advertising expense goes up by $500. And it says that we pay. So we pay with cash, so cash goes down by $5. January 21st, the dentist performs dental services for the first half of the month and receives $8,000 for services rendered. Whenever we see performed services or sold goods, we're talking about revenue. So we have done the work, so we're going to be using fees earned. Fees earned goes up by $8,000. Okay, so let's look and see if we received the money. It says we received $8,000, so cash will go up by $8,000. Alright, pays the dental hygienist $2,500, so that is going to be salaries. Salaries expense would go up by $2,500, and it's me paying for salaries. This is an expense because we use it when we pay for something that will be used up or consumed within the month. And the word pays tells me that my cash goes down. I'm going to put it straight across from $8,000 because you really don't have to skip lines as long as you put it in the right column. Bills patients for services rendered that have not been paid, $5,000. So services rendered says that I provided the services, so that's fees earned, used when you provide services or sell goods to a customer. So fees earned will go up by $5,000. Now let's see if we've gotten the cash. It says that it has not been paid. So it means that if it's not been paid, then we will use accounts receivable. This is used when your customer owes you money or pays you on account. So when a customer owes you money, it makes accounts receivable go up. When they come in and pay it, it makes accounts receivable go down. So I'm going to increase it by $5,000. Okay, so for the last journal entry, just to make sure you understand that we're debiting and crediting here. The bill patients for services rendered, we debited accounts receivable, and we credited fees earned. But when we look at it in a T account, it's just clearer. It's easier for new accounting students to actually see it this way. So we can clearly see that all of our assets increased on the left, and if we needed to decrease them, we would do it on the opposite side. Our liabilities went up on the right, capital went up on the right, fees earned went up on the right. And just as a side note, we typically never see our fees earned go down. We expect just to see increases in fees earned. And then we just expect to see increases in expenses as well, so just on the increased side. It is the balance sheet accounts over here that we expect to see go up and down. Cash goes up when you get it, goes down when you pay it. Accounts receivable goes up when customers owe you, it goes down when they pay it off. Equipment goes up when you buy it, and when you sell it, it comes back down. Notes payable goes up when you borrow money, and then it goes back down when you pay the loan off. So we expect balance sheet accounts to go up and down. We only expect these accounts to go up because we're just keeping up with what amount went toward that type of account. Okay, so the last question could be, what is net income? Well, our net income is revenue minus expenses. We just have one revenue account, and it's equal to $8,000 plus $5,000. So $13,000 is in fees earned. Okay, now we need to sum up our expenses. $500 plus $2,000 plus $2,500. That would be $5,000. So if we say our revenues minus our expenses, $13,000 minus $5,000, our net income would be $8,000. Alright, so let's see how we get our balances in the other account. These are simply one number, so that is their balance. But cash has more than one, so we need to add up the increases and subtract the decreases. Okay, so we need to find the cash balance. So we say 10,000 plus 100,000 plus 8,000 minus 2,000 minus 60,000 minus 500 minus 2,500, and our cash balance is 53,000. And we put it on its normal side because it's on the increase side. If it happened to be a decrease, then that means we are overdrawn and we have negative cash, but we have 53,000 in our account right now. Let me know if you have any questions.